Warren Buffett's famously said that he pays a lower tax rate than his secretary. The reason he's able to do this is because of capital gains. So what are capital gains? It's really just when you sell a capital good. And so if you buy, let's say, a house for $100,000, you sell that house for $150,000, that is a capital gain of $50,000. Now, this is going to include any type of capital good. It could be a stock, a mutual fund, ETF, cryptocurrency, artwork, any type of capital good that you sell for a gain, or you can sell it for a loss as well. So there's a few things we need to understand, and the first is what is unrealized versus realized. An unrealized gain or loss means you just haven't sold it yet, right? You still live in the house. You still own that stock. It becomes realized once you sell it. And that's the important date. That's the important amount, okay? And so the year that you realize this gain or loss is the same year that you have to file them on your taxes. So there's two other important characteristics of a gain or a loss, and that is whether they are short-term or long-term. This is a very easy concept, and the break point here is a year. If you hold it for less than a year, it's short-term. If you hold it for longer than a year, it's long-term. Now, you're gonna need to pull all of those terms together. So let's go through some examples here. You own a home, you've lived in it for 5 years, and it's appreciated $50,000, all right? Well, we know that it's long-term because you've held it for 5 years. We know that it's unrealized because you still live in it and you haven't sold it. So now you have a $50,000 unrealized long-term capital gain. Once you sell that house, then it becomes a realized long-term capital gain. Let's go through another example here. You bought a stock and it went down by $2,000 within 2 months. So you decide to sell it, move on to something better. Now you have a $2,000 short-term, because you've held it less than a year, capital loss of $2,000. Easy peasy, right? An important note is that capital gains and losses don't matter in retirement accounts. This is any type of tax deferred account like a 401k or an IRA. And this makes sense because you're not taxed in the year that you are buying and selling the investments in the account. You are taxed when the money comes out. You're taxed at ordinary income. There's no really benefit or different tax rate on the way out. So let's talk about the quote in the very beginning about how Warren Buffett pays a lower tax rate than his secretary. And that is because long-term capital gains are taxed at a lower rate than ordinary income. So his secretary is being taxed at the ordinary income level. He's being taxed at the capital gain level. And the capital gain level is 0, 15, or 20%. We all know that the federal level goes much higher. And so that's how he's able to keep his tax rate all the way down. Now we're going to bring this all together and we're going to talk about an important strategy when you're investing called tax loss harvesting. And this has a few benefits and it can save you a tremendous amount of money over the long term. So kind of take notes and make sure that you are either doing this in your own account or you talk to your financial advisor like myself and ask them what they are doing in terms of tax loss harvesting. So the basic example of this is you buy company A and it goes down, all right? You sell company A and on the exact same day, the exact same time, you buy company B. Now, both of these companies need to be very similar, right? They are in the same industry. Maybe they're in the beverage industry. Their profits are very similar. Their stock moves very similar. So what you're able to do is when you sell company A, you are realizing a loss. And the IRS looks at that and goes, okay, let's give them the loss for the year. But you're not just selling at a loss, right? Because you're buying company B and inevitably that's going to go up, right? So you're able to actually realize that loss, harvest that loss, but not really take a long-term loss because eventually company B is going to come back. Now, this has a lot of benefits because over the long term, if you're doing this consistently year over year over year, you can build up losses. And so when you get to the point where you are retiring or you're selling a home, you can take all these losses that your CPA is going to be recording on Schedule D of your tax return return and be able to offset some of your gains. So a good way to check to make sure your financial advisor is doing this is just look at Schedule D on your tax return. It's going to be very beneficial and kind of give you an idea of how the whole strategy works. Now, on top of that, every single year, if you have built up capital losses from tax loss harvesting, you can take $3,000 off your ordinary income. So if you're in a high income tax bracket, that can save you a good amount of money, right? $1,000, maybe up to $1,500, depending on kind of where you sit. So every single year, you're saving that amount just from an easy strategy that you're implementing in your investment account. Now remember, this needs to be a brokerage account taxable status. So we're talking trust accounts, joint accounts, individual accounts, those type of accounts where they're actually taxed in the year that the event occurs. Now, as we're building up these losses, right, your portfolio should still be going up. So you are realizing losses, but all your gains are unrealized because you're not selling the gains. So it's kind of a win-win situation here because from a tax perspective, your portfolio went down, but really on paper, which is what matters, your portfolio is up. And this is going to help, especially in the retirement planning portion of your life, because as you're actually needing to pull that money out, now you're having to realize gains and you can offset them with the losses. So do a little bit of digging, ask your financial professionals. They should be able to show you some good examples of what they're doing in their account. If not, or you're interested in learning more, feel free to reach out to us at apsadvisor.com. I'm John Gregg, your certified financial planner, and I'll see you next time.